Today's conversation explores what it really takes to build a portfolio that provides consistent cash flow and long-term wealth.
They're a surgeon and they have 6 properties and they're all none of them are worth doing. And it's a distraction and they could make way more money just handing it over to somebody else that would do a better job and be safer with them and make more money.
Are you making investment decisions strategically with great operators, or are you reacting to the next opportunity that shows up and maybe accepting more deals than you should? Hello, everybody, and welcome back to another episode of The Freedom Blueprint. I'm Adrienne Green, and today we help real estate entrepreneurs break through the grind to get the freedom that they really got into real estate for in the first place. And today I have Mike Arndorfer with me. Mike, thank you so much for being here.
Sure. It's fun.
As we get started, Mike, can you share for anybody who doesn't know you yet, what are you doing with real estate investing today?
So I'm primarily on the passive side. So I do have 4 Airbnbs in Phoenix here, and I had a couple in Washington when I lived there. In general, I look for really good operators doing lots of different things and then try to find the best sort of risk reward ratio as an LP investor. That's my focus.
And I am so excited to have you share that with us. So for all of our listeners who are other passive investors, you're going to get a lot of great wisdom here today. And for those people who are wanting LP investors in their deals, right? Here is the ideal investor telling you exactly what he looks for, guys. So get ready to take some notes as we dive in.
So I started out where I was just doing LP investing myself. Then I started, working in groups and stuff. And I've developed a coaching business, which started out to be LPs only. But now half my clients are GPs. And so, yeah, if you're a GP looking to raise, that's one of the things I find that's hard is a lot of times the doers that are the GPs, they haven't been investors themselves. They haven't thought that way. They think differently. And so they don't really understand. So if you get into the bigger teams, they have people on the team that it makes sense for them, or they just have a systematic process. But yeah, I work with a lot of GPs that are small to medium sized as a strategic coach to try to help them understand what their avatar LP investor is going to look like. Because a lot of people they take the same property and it's sort of like if you had a different, like you're a coach and you had a different team every year, but you always ran the same offense, defense, that kind of thing. It's like, it can work, but it works better if you optimize it to what your players are this year. If you have a crop of people that are really fast and not as big, maybe you shouldn't run the exact same offense as last year where they were huge dudes that weren't as fast, that type of thing. And that's the way I look at what GPs are doing wrong a lot of times when they're trying to invest. And then they just get lost in the crowd.
And I realized there was a lot of actual real estate investing knowledge there. And yet what I'm really excited about is that you used a sports analogy, because I use baseball analogies a lot when I'm on podcasts. So people can relate. And so I love that you're pulling that out. We're maybe more football, but that's good.
Which is interesting because I am not a sports guy, but I'm like one of the only guys in the country that's not a sports person.
I'm not either, but it works for, I'm not huge into sports either, but the analogies just work and everybody can relate. Okay. So now that we're done with that tangent, thanks to me, I think a lot of real estate entrepreneurs, they really get stuck looking at deals, but not always feeling clear on where their money should go, right? We've seen this with investors. What changed for you that helped you move to where you're now very intentional with your capital? Like, how did you move past that initial analysis paralysis or not sure what to do when you got started?
I would say in general, people should have analysis paralysis in the beginning. Like if you're going to invest in somebody else's deals, you want to look at a lot of deals beforehand. I mean, my current ratio is I want to like maybe 3 to 5 deals out of 100 that I look at. When I first invested, I looked at 80 deals before I picked my first 3, which they worked out. 2 were pretty good. 1 was okay. I wouldn't invest with that operator again. That's one of the things I see people not doing right is not getting enough reps in. The worst thing to do is be like, okay, I need some passive investing. I've been working, I've been in the regular market. I'm just going to jump in and do it. And they look at 3 deals and they pick 1 or something. And you might get lucky, but you don't have a very good shot at getting a really good deal with that type of thing. But there is a balance and it's getting used to it. And some of it is making sure that you understand what to be looking for. I specifically recommend reading books. There's I have a coaching program. I also work with a group that we do a group thing. You can do that kind of stuff, but you don't need to. That just accelerates it. You can do all of this on your own, but it's even better if you can get a small community. So if you've got even 3 or 4 other people that are interested. When I really made my leap forward, there were 7 of us that started looking at deals systematically twice a week, and we were looking at hundreds of deals a year. And that really kind of leapfrogged me forward because it helped me get in more reps, because when you're on your own, you're only being able to find the deals that you know about, versus when you get into a group, everyone else's network also comes in and there's always crossover, but it's things that you're finding that you hadn't heard of that sponsor before that other people are getting. And then it's really nice to see what other people are seeing and you learn from them and you get used to those reps. So looking at deals and analyzing things in a small group of trusted people is super helpful.
I love that you share that. Yes. So how did that group come about for you? So if somebody's listening and they're like, oh, yeah, that'd be amazing, but I don't know anybody, or I know only a couple people near me who are at the same level I am and looking to be an LP like this. So how did you start that group, or how did you become a part of that? What would you recommend to that listener?
That's the hard thing. When I was doing it on my own, it was hard. It was a slog. It was a lot of work to find 80 good, people that were that were worth looking at and looking at lots of deals, looking at my own. What happened then is that once I was investing, and I had been investing for years when I had my W-2, and then things really accelerated once I quit my W-2 job. And I kind of went to this as sort of, kind of a pivot type career. But I was at an investor conference, heard about a mastermind, and then through that mastermind, joined that. And then you start to get other people that are interested. And in that mastermind, there's currently 840 people. There's probably only, because I run their passive investing / horizontal income microtribe, and there's probably 250, 280 people that are there, but there's not that many that really pay attention a lot. But if you get 100 people, then you can find a few that are really doing it. So basically I had to pay to have friends, pay to join a group, that kind of thing. That then I found my people that were also serious and smart and successful, in something else. And then we could get together and start doing it.
Right. Well, and there's so much wisdom in what you just shared, Mike, because the first part is you started at a real estate, at a conference, right?
Right.
And that's one of the great things. Like, I always view going to events like conferences is, I do like to have a plan, because I have plans for everything, an agenda, like a goal, and yet just being open to what magic happens, what connection is made, what you learn that is definitely not what you were expecting or planning.
Yeah. And I'm at the point now where I'm I always try to get something from the speakers, but what I have found consistently is that the real gold and the real value is getting in a room of like-minded people. It's like, I'm showing up because I'm interested in this topic. I'm interested in learning more about this. Likely so is everybody else. And so then you've got that like-minded people coming together. So then you just talk to people. And again, you don't want to go into something like that with an agenda of like, I'm going to find, like you can just sort of have this like weird energy. You don't want that, because that kind of turns people off. But if you just have a general intention of like, I'm going to just talk to interesting people and listen to them and hear what they're doing and share what I'm doing. And, it's just sort of these things naturally, organically come along and then follow up afterwards. You could easily create your own, little ecosystem like that, doing it that way.
And for listeners who aren't sure what conferences to go to, where would you recommend, or what are you enjoying the most in terms of conferences?
There's a few that I go to that are deals that I've invested in. Like when they have conferences, I often try to go to those. One, to kind of keep up on things. But then now it's almost like, I can go to a group that's got 400 people that come in and there'll be 25 people that I know. And so it's kind of like my little small group within the group. But I know like we met at Best Ever this year. I've gone to that the last 3 years. That's changing significantly. I'm not probably going next year because it's just a little bit different vibe. But yeah, I would just pick something, that sounds interesting. There's a bunch of them, but I've done things through DLP, through Patriot, and then through the mastermind that I'm in, GoBundance, a number of different things like that.
Perfect.
And
Thank
then
you.
some local things too. If you have any local stuff, definitely try to get to those, because then you're going to be able to potentially be in person more and connected more. So those regional local things can sometimes be very fruitful.
Now, for the second part of the wisdom you gave, you said this originally came from going to, an event or conference, and then you had this group that met and you were able to evaluate everyone's deals. So the challenge with groups is you can have these groups that are amazing and great, and it sounds like yours was, and you can also have groups that are lackluster, right? Or where you're maybe giving more than you get. So what wisdom would you have to people to help them make sure, or to create those really beneficial groups and not the ones that are more of a time suck?
I think you just get lucky. It's one of those things you have to kind of try it and then see, because you don't really know until you show up. It's sort of like my philosophy on, like, if I get invited to a party that I'm going to know one person there, that kind of thing. It's like, unless I can't make it for some reason, I try to say yes, 2/3 of the time, it's going to be boring. I'm not going to meet anybody interesting, and it's just going to be kind of a waste of a night. But then 1/3 of the time, I meet an amazing person or two,
Right.
and then it's just like it's a game changer. So it's really about just showing
Mhm.
up. And so I would say
Okay.
conferences, groups, things like that. It's the same thing. Show up with a great attitude, listen, but also give. It's that type of thing. It's that balance. You don't want to be the person who's like taking over and sort of being the know-it-all, because ideally you get into a room where you barely qualified to get in the room. Like those are the best groups to get into. They let you in, but you're with 5 other people, and the other 5 people are way smarter than you on that topic. I mean, those are the great ones to get into if you can, and they don't kick you out. That's where you just like shut up and learn, but offer,
Mhm.
engage and offer where you can. But sometimes, yeah, you're the smartest one in the room, and that's fine, because you may find somebody that's really got a hustle, or you're helping somebody else kind of come along. It also, explaining something to somebody else can really help you understand what you're doing more. But yeah, you don't want to stay in that room forever. If you're the smartest person in the room, you're probably in the wrong room. And, once you identify it, it's probably time to go searching for a different group, but
Mhm.
you never know.
And what I'm hearing is say yes to any opportunity, go in and give it a try, and yet be willing to move on to if it's not continuing to add value.
Yeah, like that group of 7 that we were meeting twice a week. Within 8 months, the first guy dropped out. Within a year or so, somebody else did. Then we were down to like 4. Then we were down to 3, and basically left in kind of doing things like that. It's me. That kind of thing. Like they're all off doing other things. One dude's doing
Right.
options. Another guy's back on Wall Street. As a hedge fund. Macro hedge fund
Mhm.
trader. Running a book of business. On talk, another guy just started, he went back to his multifamily in Ohio and is crushing it there and has a debt fund and stuff. So it's like people kind of came together. These are all smart, accomplished people that were really good. But then some people like me, I'm fairly lazy. I don't want to do all the active stuff. I mean, I have a couple active things that I do, but they have to be really interesting. I live a great life, and I make, like I've got my financial freedom from, investing and that sort of thing. And so it's like, I don't want to screw it up. So I don't do anything that isn't fun. But at the same time, everyone needs a purpose. Everyone needs to do things, and you can always learn. And so I'm constantly doing things, but there's this balance of like not doing too much. So
Mhm.
I don't know. I don't know if that answers anything, but that's kind of a thought on it.
Well, I think that I want the real estate entrepreneurs listening and watching to this to really like hone in that like Mike here has gotten the freedom that people get into real estate for in the first place, right? He's still doing things that he enjoys doing that are fun and like elevate him and not all the junk, right? And not
Right.
grinding. I hear you like you're busy and yet you're not overwhelmed.
And I would say fun for me. The things that I
Mhm.
do that I think are fun, most people would find really boring. So like sitting around talking about deals all day, analyzing deals, talking to new, GPs, stuff like that. That is interesting to me. I enjoy it. I enjoy digging into decks and looking at things and finding those gems and just being like, this is garbage. Why would they do this? Or that sort of stuff. But yeah, if that's not fun for you, don't, you're not going to do it well. So maybe don't do it, or do it
Right.
very minimally.
Mhm.
But one of the things that I have found is that when I quit, probably 2 years before I quit my W-2, I got a real estate license, started doing commercial real estate, was thinking like, okay, I'm going to start getting into the deal flow more, because I'd been a passive investor in private alts for quite a while, but I'm like, I want to own mobile home parks. And that was going to be my thing. And the more I started to dig into that, it was a frothy enough market that I recognized as me coming in new. I'm smart. I ran companies. I can do things, but I'm like, I am going to make mistakes. Like if I am paying the most, if I am the person that pays the most on this thing, and there were 17 offers, it's because I missed something. It's not because I'm lucky or because I'm smart or anything else. It
Right.
was in that type of market where it's like, I knew that the first 1, 2, maybe even 3 or 4 parks that I bought, I probably, didn't get it right. As much as I due diligence and work as I did ahead of time, there was going to be enough competition at that point in time. So I'm like, okay, I want to own this asset, but do I really want to own it, or do I just want the income stream from it? Like I believe in
Mhm.
it, but I'm like, yeah, do I want to deal with that every day? And I really didn't, especially at my age. And the idea of sort of like, what is my life going to look like in 5 years, 10 years, 15 years? If I was 25 or 30, that would have been a different choice. But I started that at 48. And so when I'm in that zone, I'm like, no, I don't think I want to do this, because I'm going to be making my mistakes, like 48 to 52. Then I get into a sweet spot. I'm okay with it. I'm kind of average, probably like 52 to what, 57 or something. And then I start really hitting it. But it's like, I don't want to be buying mobile home parks and like, running them and turning them and filling them when I'm in my
Right.
late 60s. So I'm like, screw that. I'm just going to find the best operators. And so what I did is I took the same amount of time that it would have taken me to be looking at all of these deals and crunching the numbers on them and underwriting and all that kind of stuff, and then visiting parks and figuring out how to do it and then running them. I just took the same amount of energy and put it towards looking at other people, finding the best. And there's kind of two things. There's best that are absolutely the best, but then there's the best that pay the most. And so you have to find that balance, because you can find the best operators, but oftentimes when they're at that level, they're not giving very good splits. And there's
Right.
people out there that started out at, like an 8 pref and an 80-20 split to the LP, that then 4 years later, they're giving you a 10 pref, but it's 20-80 to the LP. And it's like, I don't have any interest in that. Like, they're great operators. They've learned more. They've proven their track record, but it's like, it's not worth it to me. I'm not going to invest with somebody like that. So I'm looking for that person that has enough proven track record that they're doing it well. I've invested with some freshmen, but it's only when I know them, and it usually hasn't gone as well as I thought it would, even though I've known them and I know them personally, kind of thing, and I know their character. So
Right.
freshmen are tough, but you can find a star sophomore, and that's really the sweet spot for me. Those people that have done enough deals, they've figured things out, they're doing well, but they haven't turned on that
Right.
marketing machine yet. Still, it's hard to find them. You have to know them. Versus you can go invest with a star senior, and that's great, but you're not going to get the same returns. So,
Right.
but me, like I said, I do this for fun. I look at deals like this just for the fun of it and like dig into the minutia of like why like one little rule different between one fund and the next can make a huge difference that you may or may not understand. So I look for that stuff. But for most people, if you're like partially interested, that kind of thing, yeah, you're probably safest just go to the star senior, get a little bit lower return and call it good. That's a much
Right.
safer thing than playing in the space where I love to play in.
Well, and I like what you shared. I think multiple aspects of what you just shared hit on the point of like, there's so many different ways to do real estate, to do real estate investing.
Yeah.
And there's not that one way is better than a different way. It's which way is best for you.
Yeah. And here's one thing I've found is that, so I'm going to talk about kind of two different groups. So one group is they're really good at something. They, are great at whatever it is. So let's say it's land entitlement or whatever they're going to do, or they're doing fix and flips and keeping some of them to rent out in their own market or whatever. For a period of time, you should probably put all of your money towards investing with you, working, on your own, that kind of thing. That's usually what makes sense. If you're really good at it, do that. Where I've seen things go bad is like you get to where, and maybe you've got a net worth of 10 million at that point. It's like somewhere along the path. It's probably not $1 million or 2 million. It's probably not 5 million, but somewhere between 10 million and 40 million of net worth that you've created through that one thing that you're doing. You're going to be like, you know what? I probably should diversify. I've seen a couple of people that are able to diversify and go into another area to do the same thing, or they go into another asset class in that area or another area. But the vast majority of them screw it up. Just continue to do your one thing and then find great operators that are doing something else and just spend a little bit of time finding the best people. But the hard thing is that those people, they're the doers. They're the entrepreneurs that are like, no, I'm going to do it. They like only trust themselves.
Right.
And it's hard for them to trust someone else. But I would say the vast majority of those people that try to make that transition from, let's say, multifamily to storage, they screw storage up, or multifamily to buying HVAC businesses or something along those lines. So that would be one thing I would say is keep putting in and doubling down on you until it gets to the point where it's like, okay, I've got enough in this bucket. It probably doesn't make sense for me to keep mashing on the gas. I should probably diversify, because that's that whole idea of you're building wealth, but you also want to keep wealth. And at some point you've built enough that you're focusing on making sure that you keep it. And so I think that's one thing to go over. The other is that, to be honest, a lot of people are not good at this. They're not. They're busy with their business. They're busy with their W-2. They want to get into real estate and they buy crappy deals. They don't run them well. And if you sit down and actually analyze what your returns are, you're not doing well. Like you could make a lot more money putting it into a hard money lending fund or into some sort of other deal that, is going to be, somebody else is running it. And so I think for some people, it's taking an honest look at it. And there's nothing wrong with being bad or mediocre at something for the first 1, 2, 3 deals. If you love it and you're focusing on it and you want to build it, great. That's your learning tuition and you need to do that. But what I see that the doctor, the dentist, the business owner that's kicking off some big income that feels like they need to have something else. They don't have the time and attention for it. And they buy crappy deals in their neighborhood and they're not returning that much. And those people, I would say, just give up. Enjoy your time, go golf, go playing out with your kids, whatever. Just find a great operator that you're going to invest alongside instead. But if you're 28, 30 and you're planning on this being your big thing and you have what I would call like more of a normal mediocre job, great. Keep doing it. Learn, see if you can get there. But yeah, if you're a high earner and you're not doing well, just give up, stop, take that equity out, strategically get out of those things. Because I see so many of my clients, they come to me and they're a surgeon and they have 6 properties and they're all shit. None of them are worth doing. And it's a distraction and they could make way more money just handing it over to somebody else that would do a better job and be safer with them and make more money and not take their time.
If you're a real estate entrepreneur trying to scale while doing everything yourself, there's a better way. The Time and Freedom Starter Pack gives you the exact first steps to reclaim hours each week with real support, including what to hand off, where to start, and simple tools you can put into place right away. Download it for free at adriennegreen.com/starter pack. Now let's get back to the episode. It's like I feel like so many of the people you're talking about, like the high income earners, they get the advantage of the tax write-offs, right? The depreciation or things like that, especially in the short-term rental world, if they can get like the loophole or something like that.
Last year we only lost $12,000 or this year we made $20,000 or something like that. It's like, it's a horrible return, like that's not, you're not winning.
Right. And the challenge is then when we have investors like that, it keeps mediocre operators or even poor operators in the field because they have these clients.
Yeah.
So for somebody who doesn't want to be that person, right? I'm going to invest passively. I know I'm not going to, be the operator myself. When you're first evaluating a deal, we know we're going to have acceptance rates in the single digits, the low single digits. What would you say to somebody are like the first few things you look at to decide if it's a yes, no, worth spending more time on?
I mean, there's a lot of things. So one thing, you need to kind of build out your overall strategy. Like, what are you doing? If you are a cash flow investor and you only want cash flow, and this is a development deal that isn't going to have any cash flow, it's just appreciation. Well, then, you're just stop. Don't look at it. Now, like I am personally looking for this mix of depreciation to help me with taxes, cash flow to live off of, and appreciation to sort of like keep my nest egg growing. Do a ton of different things and purposefully build a very diversified thing. But I'm also not that person that's doing just 1 or 2 deals. And if you're looking for that, just make sure, I would say, first of all, that the deal makes sense that way, that you're looking at the right types of things. The most important thing is going to be the GP operator, but that's also the hardest one to really screen for. But that's really where things come down to, making sure. So macro wise, macroeconomy, that's your biggest risk. Is there anything going on that makes you really nervous about investing right now? And then you've got kind of the micro for that. It's like, okay, this is class B multifamily value add in this market. Is there anything about that is sort of a risky, dangerous type thing? And if it is, maybe you don't look at it. And then the next thing is the GP operator. That's going to be your most important thing. I mean, the others are really important too, but really they're a little harder to predict. I think that the GP operator is a very important part and really focusing on that. And then the last thing is the specifics on the deal. And so, you may want to screen for things, but I see these things where you have let's say you have a building that somebody's going to buy. You could have operator 1. There's 5 things that can go right or wrong on the deal. Operator 1 assumes that all 5 go wrong. And so they put out that you're going to get a 12 IRR, because even if all 5 things go wrong, that operator is good enough that they can get you a 12 IRR. Operator 2, they put out a 22 IRR and it's legit. They'll get it if all 5 things go exactly perfectly. But guess what? That operator, if 3 of them go bad, they're going to lose the deal because they don't know how to do a good job with it. And so, and that's a vastly different thing. And it takes a lot of sort of like looking at deals and analyzing things to understand that. That's kind of the first thing. The next is that, making sure that the risk on it makes sense for you. Because again, same deal, but operator, 2 puts on a 60% LTV and they, so it's fixed rate debt. It's a lot of equity and you're going to get lower depreciation. You're going to get, lower appreciation, that kind of thing, because you got so much in there. Operator 2 comes along. They put on an 80% loan. It's a, short-term type thing that they're going to be turning it. And then they come along and they do like 2 share classes. And one of them is a fixed, like 10%. And then the other one is like a 8 pref and a 70-30 split. Well, now you're at that point where that common equity, that 70-30, you've only got 10% of your money there. And so it's like 40% of that type of money versus 10%. So if it goes well, operator B is going to make a ton more money. But if it goes wrong at all, you get wiped out versus the other one has a lot of robustness. They can work through things. You can have something happen to where they thought that there was going to be 95% occupancy and you dip into 84 for, 2 years and you can hold on to the property. The second one, they're going to lose it. It's the exact same property, same market, same everything. It's just like, but if it goes right, way more money, way more appreciation, way more depreciation. Like it's a much better thing if it goes well. I'm just thinking about things like that. Like how are they setting it up? But it's a tough question. It's a whole process to kind of go through all that kind of thing. So I would say, reading books and making sure you really understand, or getting into a group, or going through some sort of a training program are all good things.
Right. I mean, there's so many aspects so many levers that the operator can pull in these deals, like you're saying, that can make it look different. And, especially new investors are often caught by that higher return, right? And they don't see everything that's under the water, right? All those differences.
Exactly.
Behind the scenes.
Yeah. The other thing is like you come across some operators where they're just like, they are so sure something's going to go this way. They know exactly what it's going to be. And they gloss over some important things. Like, I'm like, okay, well, who's going to be the property manager? Like, oh, we're going to get an outside property manager because they're going to be great. I'm like, okay, well, who is it? It's like, oh, well, we haven't chosen them yet. I'm like, that's who's going to run your whole thing. Like most of the time when you hear like a multifamily not going well, it's because the property manager messed up. So making sure that they have all those key things versus like, I partnered with a guy a year ago. We've been friends for a long time. Great operator, small market, vertically integrated. He just mostly does all of his own stuff. But it was like, as the investor relations money person on the GP team, it was tough to get him to like, okay, let's create a deck. And he's like, well, I don't know how it's going to go. I'm like, well, what do you mean? We have to have a plan. He's like, well, there's 12 options. Like he knows that there's 12 different options and he knows exactly what he's going to do in all of these different scenarios. He's like, I don't know which one it'll be. Like who could know? I'm like, well, the investors need to know something, like pick your best one. And he's like, but I don't know that's what's going to happen. It's like, I'm going to do this, this, and this. If this happens in the market, I'm going to do these things if this happens. And it's like, that's that operator that you really want. Like, I'm like, yeah, that's who I want to work with because he just knows operations. He's going to be able to pivot. He's going to be able to do those things versus the people that are like, nothing can go wrong with this. I have no idea, like this is an amazing deal. We're just going to do this. It's going to work. And we're going to make a bunch of money. It's like, so.
Right. And
I'm kind of getting on
it
a
can be a
tangent.
challenge. Yeah, well, no, I like that because it's like that operator that you're saying who's going to be a great operator, not necessarily the best salesperson, right?
Right.
And that's
exactly.
the challenge. And sometimes
Those are
those
the people I
operators who
try
are
to
great
invest with.
salespeople are bad.
Yeah. You want somebody that has enough professionalism that they have a real deck, they have a team that, things are going on. But I really, in that, what I would call that star sophomore area, I look for somebody who is not a good salesperson, who is not good at raising money yet. That's where you can really find some people that are good deals and you're making an outsized return with it. By the time you get to that star senior, which again, if you're not going to spend a lot of time on this, just go to those people. Go to the people that are institutional grade or near institutional grade. You're going to make less money than me, but you're going to have less chance of having a wipeout. Right. And so, which, like if you take a 0 on a deal, like that makes huge difference, kind of thing. It's like, if I'm making 18% and you're making 12%, but you get 10 right and I end up with 1-0, you win. Even though I had 9 of them that returned 18% because I got 1-0 out of it. Anyhow, trying to find those people that maybe aren't as good at it is, but then again, you got to be dedicated to finding them and really digging in. And most people don't. And so if you, just be honest with yourself. Do you want to do that? Does this sound fun to you? Or if it's not, then don't do it. Go with the name brand, proven track record people.
Yep, I think that's a good point. Now, you obviously look at all of these different opportunities a lot. There's one specific model I'd love to ask you about, and that's the infinite return model. I'd love your
Mm,
insights and thoughts on that. Now, for our listeners who aren't familiar with it, the idea is you're going to invest in, let's just say a multifamily, right? Value add. We have this initial investment syndication. And then the operators, the GPs, they make this improvement, they increase the value, they do a cash out refi. So they return the original capital to their investors as a non-taxable event because it's a refi, and all the investors stay in the deal for, a long time, right? Typically they view
decades.
like, yeah, decades. And then you continue to get the returns on this property for these decades, and you have your capital back from that cash out refi to reinvest. So
Yes. So I
with
would
that model,
say
I'm
it
curious what you like about it or dislike or what you
is
think.
my favorite thing in some asset classes and what I try to only do. So, for example, mobile home parks are my favorite asset class. I think that they have a great profile. They're really hard to screw up. They're incredibly hard to build new ones. The only thing I haven't for sure lost all my money on, but it's likely I'm going to lose all my money on it from a 2021 investment was an amazing mobile home park out just right by Bozeman, Montana. Beautiful thing. It made complete sense. We had 300 people interested in it. We had local people. We're all on board, the politicians, the whole thing. Screwed it up. We're losing all our money, likely. I mean,
Mm,
maybe I get 20% back. Best case scenario. My base case is that I end up losing all my money on it. They are hard to do. It's hard to get people in. They're not making more. That usually the land, it's not the best use of it. And so if anything, about 100 a year or sometimes more get plowed under to get turned into industrial or to single family or multifamily. So for a multitude of reasons, I like mobile home parks. Then on top of that, they have a lot of depreciation. I happen to have real estate professional status. And so therefore I can use that depreciation. So the infinite return model for me in a mobile home park is my preference because I want to own the asset for decades. I want take the depreciation and it stays buried. And then you kind of get the cash flows. And so that's my preferred method that way. I also do that with really good multifamily, but the multifamily has to be in an A to A plus location. Like it has to be that type of thing where it's like this location in this town is ideal. Like this is where people are going to be, like it's been that way for 50 years. It's going to be that way for another 50 years. I want to own this for long haul. Your average
mhm.
run of the mill, multifamily that's in a suburb, B class, value add suburb. I don't want that. Give me my money and let's move on. That isn't a legacy asset that I want. So you have to first decide, is this a legacy asset that you really want to own 30 years from now? And then if it is, and the operator seems good, infinite returns are amazing because you get all of your money back, you recycle it back, and then you move on. And the recycling back can take anywhere from 2 is the quickest I've seen it. 3 is usually the fastest. A lot of times they predict 5. I've seen some not return it by 6, but somewhere along those lines, you start getting it. So I've got one that I put money into in 23. Again, I committed in 22, put the money in 23. Like 33 months in, I'm getting 90% of my money back, that type thing. And then I'm going to keep owning it. So there's a multitude of reasons why in some cases it's good. Where I don't want to do it is an asset that I don't love. I invest in storage, but storage is really easy to put in. There's very few storage assets around the country that I would say are a legacy type asset.
Okay.
It's too easy to build and that type of thing. And so it just depends. But yeah, it can be a beautiful model. I love it. And it is by far my preferred thing in the right asset. And then in other things, I wouldn't touch it.
I loved that answer because it's one of those things, it looks so great in theory, right? The infinite return model looks great in theory, and yet nothing is perfect. And so I think what you did is explain exactly when it is a win and when it's not, so that we can have that really full view of it. Yes. Now, also, guys, if you are interested in mobile home parks after what Mike shared, remember, go back about 4 or 5 episodes with Leo Young. He shared all about mobile home parks. So if you're looking to learn more about that asset class, go back a few episodes and listen to the one with Leo Young where he shares about that. Well, I feel like I've learned so much. I feel like I have a new college degree in investing here from our time with Mike. Well, thank you, listeners, for joining us for another episode of the Freedom Blueprint. And be sure to join me next week for some more insights and wisdom to help you get the freedom that you're going for.